Okay, we're going to have a look at an IFRS 3 example. 90% of it is for level 1 and 2. There's a little bit over here, which I think is a little bit far-fetched for level 1. Okay. It comes from, or it's based on an example that is in the UNISA material. Right, so you will see this example in the level 2 material, or one very similar to it. I've modified it ever so slightly. And if I take you through the fact pattern, so you can see how it is that we need to apply what we've done on IFRS 3 up until this point. I acquired a 15% interest in S on 1 July X7 for 3.5 million. Bless you. They are obviously carrying that investment at fair value because it currently has a carrying amount of 3.9 million. And that has been valued through other comprehensive income. We acquired a further 40% on the 30th of June. And just to make it clear, each share carries one vote, wada, wada, wada. So let's just use the term there that we get control on that date. The trial balance of S at that date has some share capital, retained earnings, and a share-based payment reserve. Okay, that's the bit that you level ones will not really have to deal with. NCI at fair value, 11.8 million, and they've told us they want NCI at fair value. That is to say, we're going to be on the full goodwill method. If in a subsequent year we need to impair that goodwill, NCI will get a share of that impairment loss. Okay. Just to correct the wording there, just want to make sure you know that is at the acquisition date, just to be absolutely clear. It does say that at the top, so just to be clear though, at 500,000, the machinery is undervalued by that amount. S has a contingent liability disclosed at 1 million, so that's the potential loss. And then, although they haven't said it in as many words, the amount that we would have to pay to get out of that, to negate that risk, is 300,000 Rand. Okay, so that's the closest thing we've got to fair value at the acquisition date. Subsequently, the sub makes a provision of its own at the reporting date of 350,000. So when you're doing since acquisition to beginning of year, or in this case, since acquisition till end of year, because you bought the sub halfway through the current year, whatever liability we reflected at acquisition must now be reversed. Okay, so you can't have the IFRS 3 liability and S in its own books has a separate liability. All right, so if S doesn't have a liability and we need an IFRS 3 liability, provide for one. But once S provides for the liability in its own records, we can reverse the liability that we provided for at the acquisition date. Transaction costs included in all amounts payable are 100,000. Okay, just to point out, and I mentioned it earlier, but I just want to reiterate that the transaction costs are always expensed in profit or loss, unless some other standard tells you otherwise. But expensed in profit or loss, make sure you do that. All right. What you're watching out, that's a simple entry. So if a question says to you, you paid transaction costs of 500,000, debit, expense, credit, bank, 500,000, done, no problem. Right. It's like, this is the one you got to watch out for, because they're telling you that included in the amount you're paying for the sub is reimbursement of the transaction costs that the sellers incurred. All right, that's the one you've got to watch out for, that we're going to have to be very careful not to include that in the investment. And they told us that a while back, A granted S a right of use, a 5-year period with a 4-year renewal. Okay, given the fact that this is a transaction between A and S, a pre-existing relationship, you know already that we're going to completely ignore the renewal period. Right? The trick they want you to fall for is to use the total period, not just the renewal period. Let me make it clear, if that was a third-party agreement, you would consider the renewal period, okay, if it was seen to be advantageous. The actual license fee is 40,000. A fair license fee is 50,000. All right, so there is an off-market component. I can tell you with certainty there is going to be a settlement gain or a settlement loss. Yeah, we're having a ball today. A silver clear XTV, I think, 193 GP. Are you here? Because this person has left their door open. Thank you. In addition to that, we are told that the value of this right of use to S is such that it can create future inflows of 120 along with related costs of 20. That excludes the annual fee. There's no asset or liability in H or S's books as a result of this. So that trademark would be an intangible asset in terms of IAS 38. Initial recognition of an intangible asset would be at cost. So I think they're arguing here, it didn't have a cost. I'm just going to pay for the right to use it for the next 5 years. All right, so no one's got any assets or liabilities in their books. All right, but you've established there that at a group level, I need one of these reacquired rights. Okay, and in HCO's records, there's going to be a settlement gain or settlement loss. Tell me quickly, settlement gain or settlement loss? Hands up for settlement gain. 1, 2, 3. Going, gone. Hands up for settlement loss. Let's go with the majority. Settlement loss it is. No. From the holding company's perspective, they're receiving less than they should be receiving. Okay, that's how I asked you to look at it. All right. So yes, they're happy to get out of this agreement. That doesn't mean it's a settlement gain. That means they would have been prepared to pay to get out of the agreement. So we're going to show that extra payment, which we're going to factor into the equation as a settlement loss. Unfavorable to the holding company, settlement loss. All right. And then the agreement may be terminated for a penalty amount of 80,000. You will see just now when we do the calculations, your settlement gain or loss is actually going to end up being the lower of the penalty and the present value of the off-market component. Right, all of the stuff relating to the share-based payment, let's ignore for now. And then we are told that the extra 40% is going to be paid for by issuing 100,000 shares, paying 8.5 million, but take note of the date, transferring a machine with a carrying amount of 150 but a fair value of 200, the share price on the acquisition date is 20 Rand. The share price on the day you issue the shares is irrelevant. there's a contingent fee payable if, and the fair value of that contingent fee is 320,000 Rand on the acquisition date. It is 350,000 Rand on the reporting date. So in the period since acquisition till end of year, the holding company in its own records is going to debit loss credit liability 30,000. All right. I'm not going to do those entries with you. I'm only doing the at acquisition ones. But if they asked you for a statement of profit or loss, I would expect to see that 30,000 loss in your other expenses. 12% is a discount rate that should be used where appropriate, and then read the required damn carefully. And here you have to be very, very clear on what they're asking for. Here I asked for both. So I said, what are the journal entries in the separates and what are the pro forma group entries? All right. Sometimes they will ask you just for the pro formas. Sometimes they ask you just for the separates. So look at what they're asking you. And then just to remind you that where we acquire a business that is not a separate entity, where we acquire a business by buying the assets and liabilities, there are no pro forma entries. That's the one where you bring in to H's separates every asset, every liability at fair value that they're acquiring. You pay for it. You're going to have the assets, the liabilities, and the equity given. You're going to have the settlement gain or loss. You're going to have the transaction costs, all in that same entry, and your balancing figure is goodwill or discount. So it was mentioned to me just before we started, okay, that there you get goodwill in the holding company's separates. You never saw that in undergrad. In undergrad, you only ever got goodwill in a group. Understand, you can get goodwill in the separate financial statements if you acquire a business by buying the underlying assets and liabilities. Here I asked for both. So kind of picture-wise, what I would expect you to be able to do. And this is the donkey work that you can put in place, which limits a lot of risk. All right, so I'm saying the journal entry in the separates of the holding company, or the parent or the acquirer, is going to be what? They're going to have, let's call it investment in subsidiary. Then we saw already, I read there were transaction costs in profit or loss of 100,000. Why wait? I've established already that there is a settlement loss. And please, if they ask you for the journal entries, you can't use my hieroglyphics, eh? You've got to write out the words settlement loss, spelled correctly, punctuated correctly. Neater than this, okay? And then we've established there was that we gave up a, what was it, a machine, or how did we pay that amount? I said earlier, you paid for it in, I'm just going to call it property, plant, and equipment. Then we gave up an asset with a carrying amount of 150. But it had a fair value of 200,000. So there must be a gain on disposal of 50. You can do them as separate entries, but I'm saying for that part of the transaction, it's debit investment, credit asset, credit profit on disposal. We're going to have 200,000 in the investment. I know there's a liability. I'll have to do the calculation. I know there is contingent consideration. 320. I don't know. If you can do the basic stuff like that, you know what, you get, it's a start, eh? All right, let's jump into the different calculations there. So the settlement gain or loss, we'll go and do a little calculation there. And for that settlement gain or loss, I said to you, the settlement gain or loss represents the present value of the off-market component. So your calculation, what did we say? Market value is 50. Actual is 40. Off-market component is 10. For how much longer? Right, so payment equals 10,000. N equals, if you look at the period that we're dealing with here, if I'm not mistaken, it was a 5-year agreement. 1, 2, 3, 4, 5 years. When did we enter into that agreement? I think it was the 1st of Jan X8. We are currently over, so that's X9, that's going to be X10, and we are currently at 30 June X10. That is our acquisition date. So you can see from that that 2.5 years are gone. That means we've got 2.5 years left. Those of you saying you can't have N as 2.5, you are correct. Right. That is a Unisaism. In fact, if you've got a Casio calculator, it'll tell you you're crazy. It'll give you an error. All right. Strictly speaking, you should discount that thing back 2 periods, and then that lump sum, you should discount back another half a period. All right. But UNISA thinks it's okay to have N as 2.5. People, in that formula, N is not the number of periods. It's the number of payments. They're not 2.5 payments. They're 2 payments left. All right. Anyway, you need so happy with 2.5. I is equal to 12. Future value is equal to 0. I need the present value, please. $2,560. And we've established that that is a settlement loss. The other calculation I've got is for this liability over here. It was 8.5 million, was it? Not payable today. It was payable in 1 year's time. Future value is 8.5 million because it's a once-off. Payments along the way, there's nothing. If they said you've got to pay interest every month of X amount, then put in that interest in every month. There was nothing here. Your N equals 1. Your I equals 12. You will please compute the present value. That's it. $7,589,286. Nearly forgot about it. We also paid in shares. And you may or may not have issued the shares on this date. So you can either call it a share-based payment in equity, SCE. Or if they've actually issued the shares, call it share capital, okay, which I think would suffice in this one. SCE. And there it was, if I'm not mistaken, 100,000 shares at a fair value of 20 Rand per share. Okay. If they were asking you for entries, they would give you, no doubt, a half and 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 a half for your descriptions, as long as they're reasonable. But where they would penalize you and give you nothing is if you didn't put in the PLs, the SFPs, and the OCIs and the SCEs. The amounts here, that would be a half because it's given. I'm guessing that would be a half, a half, a half, a half because of the different inputs. So payment, N, I, work out PV. That was given, that you had to work out. That was probably half, half, half because of the inputs. That was given, and that is probably a half and a half. All right. Level 2s, you will see there's also another share-based payment reserve over here. Statement of changes in equity, and that comes about when an acquirer replaces a share incentive scheme in the acquiree. I just can't see that being examined at level 1 ever, because you don't do share-based payments under IFRS 2 in the 4863 or the IFRS paper. Okay, level 2s, we're going to have to address that. But if that was there and you didn't know how to deal with it, what are you going to do? If you don't know what to do, don't do anything. Don't waste your time there. You're getting it wrong anyway. Add up what you've got and call it balancing figure. Then they know it is made up of the credits minus the debits. Otherwise, if you want, you can go and write as another working 2 million plus that, plus that, plus that, plus that, minus that equals that. All right, balancing figure. It's your call. All right. Hey? Yeah, of course you do. Yeah. Now you get the same amount of marks. I can tell you in this one over here, all they're going to award you with is a half and a half, showing it's your balancing figure. Right. If they had asked you to prepare a statement of financial position, then the line item investment, or if they asked for the journal entry, the pro forma, then that line item investment, they'd need to refer back to the working. And then they would go and say, how did you get that? And if you have a overly pedantic marker and you don't show that's your balancing figure, he's going to say, well, how did you get that? All right. And then it becomes either you get the 6 or you don't. All right. The other entry they asked for looks like this. We're going to have share capital. We're going to have retained earnings. There was a share-based payment reserve. So that's all the equity. All right. You would consider, and this question's a little bit flawed in the sense that I did acquire the sub halfway through the year. So what you would actually expect to see is a trial balance at 30 June. And that trial balance would be covering the period from the 1st of January to the 30th of June. And in that instance, they would probably give you the retained earnings at the beginning of the year, and then the income and expenses for the period January to June. So you will eliminate in the statement of changes in equity everything up to beginning of year. But the profit or loss items for the period before it became a sub, or before we got control, they need to be eliminated out of profit or loss this year. But that will only happen when you buy a sub in the current year. Then I've already picked up that there was PPE that needed to be revalued. Can you remember the number? 500,000 was it? 400,000? 500. 500,000. So we're going to revalue that guy, SFP, by 500,000. And then take my advice. I think it's worth your while to do the tax as you go. You're welcome to go and do all the tax afterwards, okay? But kind of do the tax as you go. If I'm not, I think maybe in this example I said ignore tax. All right, I can't remember what I did. Right, but if you could not ignoring tax, you'll provide for the deferred tax on that. Okay, we've established also that there was a reacquired right. And the calculation for that is as follows. Okay, what's the value of that trademark? In the acquiree, in the subsidiary. And we reckon their inflows are, was it 120? I think it was. The outflows are 20. So if you did this valuation in Manac, you would do a discounted cash flow type calculation, or you'd do a NPV type calculation. And then there's the payment. There's the payment they make every year, which is 40,000. All right. Please understand, if you're going to calculate the fair value of this thing, you need to take into account fair amounts, not Mickey Mouse amounts. All right. So just take note, you will not use the 40,000, the actual payment. You'll take into account a fair rental if you want a fair value. And that leaves us with 50,000, which was a pity in the question because a lot of people seem to think that 50,000 is the payment. It is not. Okay. That is the annual benefit which S can enjoy. So we're going to say payment equals, what was this? Just call it expense. Payment is 50,000 in your calculators. N equals 2.5, which is rubbish. I equals 12%. There's no future value amount. Calculate the PV, please. 102? 102,801. So 102,801. And the deferred tax on that, credit DT SFP at 28%, please. 28,784, like that. Thank you. While I'm at it, let's get the easy stuff as well. The share capital and reserves, there are 14,9,715, so it's 14,975,285,000. As it turns out in this question, it's not great, eh? The income and expenses of the current year are in the retained earnings. Right. If you printed out a TB, folks, at the 30th of June, the retained earnings would not include the profit from January to June. Right. But they've given it to us like that, so we'll just deal with that. Okay. What else was there? There was a contingent liability with a fair value of 300,000. If that's tax deductible when paid, put in the deferred tax asset. If that's not tax deductible when paid, there is no deferred tax asset. Did I say in this question? No, I think I said ignore tax. But if SARS was going to allow that, put in the deferred tax asset. If not, don't. If you're in doubt, don't leave it out. Right, what else did they tell us here? Okay, so NCI is 11.8 million. So I've done that, done that, done that, done that, I've done that. I've done that, that, and that. I haven't done that because it's really hard. I've done that, I've done that, I've done that, I've done that, I've done that. Okay, so add up what you've got. If you're having, it would probably be a very good day if you got that far. Then you'd finish up by calculating your investment. All right. I want to add one more thing to this investment. That's the way that UNISA did it in their solution. So you can just see what UNISA did as well is they said the other thing that's gone is that old investment. That old 15% investment used to be a simple financial asset at fair value. So what they do is they say the investment in, well, let's call it investment at fair value, as opposed to has now become a subsidiary. So they're literally taking it out of the account called financial assets at fair value through profit or loss, and they're putting it into the account called investment in subsidiary. I did a little bit different. I'll show you what that is now. And that was 3.9 million. All right. Therefore, your investment is made up of everything you paid for today, including the fair value of your previously held non-controlling investment. What I tend to do instead of that, only because I remember it better, is I will have investment here, old, investment, new. Okay, so if you've wiped out the investment old in the other entry, then you can just call this investment in subsidiary. And what does that comprise? Everything you pay today as well as the old investment. Otherwise, just put in the old investment there, and whatever you paid today, that's your new investment. Okay, and that will give you a balancing figure, which turns out to be goodwill. I've given you the answers there, and you can go and redo it. Okay, but this is where you've got to start being grown up about this stuff. All right, or you've got to become insensitive about the fact that you're not going to get the same goodwill figure. That's not important. What's important is you went through the motions. So if I say to you, give the pro forma journal entry at acquisition, do you know what sort of things you need to consider? And quite honestly, either you do or you don't. If you think reading IFRS 3 is an option, okay, think again. IFRS 3 with the examples and basis for conclusions is around about 300 pages long. All right. I've tried to give you what you need to know in, I don't know what it was, call it 2.5 hours. All right. And if I was you, okay, and you want to take my advice, that stuff that I've taught you today, I would know that. So those little entries I gave you with all the X's in them, I would say, take out a blank piece of paper and do you know what goes in H's books, what goes in the group if they buy shares? Or do you know what goes in H's books if they buy assets? And I would say to you, that's binary. Either you know it or you don't. And if you don't know it, I'm not saying you won't find it. They tell you all of that stuff in the 300 pages. All right. But I'll warn you, it's going to be a 15 to 20 mark part of the required. The calculations are going to take you, I don't know, 10 minutes. That leaves you another, call it 10, 15 minutes to close the deal once you've done the reading and all that jazz. Okay? You're not going to, I don't know. If you can read 300 pages in that time, then you're okay. Well, read 300 pages with 100% comprehension, you're okay. Chances are you won't be okay. So don't put too much emphasis on the open book. And I had a guy on Facebook this week panicking. He doesn't know how to tag for Manac. So the query goes, he's like tagging fiercely. I know we need to tag for IFRS and audit and tax. Please confirm that it is not a requirement, I think was the wording used, to tag in Manac. People, it's not a requirement to tag anything full stop. If you come across something important that you think, you might like to remember where that is, highlight it and tag it. Otherwise, quite frankly, if your book looks like this, that's also okay. I need to find something. What do you want to know about? Measurement period, adjustment. Okay, so first of all, you need to know it's IFRS 3, and then you're going to go to IFRS 3, and you're going to look in here, and it tells me, there we go, contents. Let's see if I can find, there we go, measurement period, paragraph 45. There, how long did that take? Or you had a tag in there that said measurement period, in which case you went straight there. You saved 10 seconds. The problem is, most of you have got so many frigging tags in here. Magnifying glass. Crazy. And so those books are a thing of beauty, but it doesn't have to be a work of art, okay? It's got to be user-friendly. I just replied on the post, less is more. And I maintain that. Okay. So again, you get the picture, hey? You need a structure. There's certain stuff you need to know. Once you know it, you can move forward. Until you know it, I promise you, you're bashing your head against a brick wall over and over again. You're focusing on, oh, how did they get that? See, the truth is, it doesn't really matter how they got that. What was important is you identified that there was, a reacquired right on which you should have provided for deferred tax. And whether that's normal rates or CGT rates depends on the fact pattern presented. Okay, so yeah, just get your structures in place. The basics you need to know. Once you know the basics, you can move forward. Until you know the basics, really, you're up against it, hey? And then the red mist comes down and, oof, horrible. So last little thing, level ones, you can sort of switch off a bit if you want, is that share-based payment reserve. I am going to cover this at a rather superficial level, okay, because we haven't done share-based payments yet anyway. But it is something that is common in IFRS 3, and they have tested it repeatedly in test 1. All right. So, looking at this scary information in point 6, they basically tell you, in a nutshell, that on the 1st of January X10, 1 Jan X10, not grat, S granted to its employees share options. Right. So in other words, they embarked on a share-based payment scheme, and the grant date to S employees by S was the 1st of the 1st X10. Our acquisition date is the 30th of June X10. And then if you read carefully, in order for staff to benefit from the share-based payment scheme, they had to work for us for a period of 3 years. That is called the vesting date, or that yellow line is what we refer to as the vesting period. And that would be the 31st of the 12th X12. 3 years. Okay, so that's just interpretation of the facts that they've given to us. All right, just pay attention to detail. Yeah, draw the line, make it a picture. It's a damn sight easier than, counting on your fingers and toes and then trying to remember, and then your one finger gets a cramp and all goes pear-shaped. What happens at the acquisition date is H agrees to replace that S share-based payment scheme with an H, or in our case an A share-based payment scheme. That's commonplace. If, for example, S was a private company and A was a public company, believe me, your staff would rather have the marketable shares in the public company than private company shares. All right. So this then, the acquisition date becomes the H grant date, or the replacement date. H does put in place one little modification in the sense that they say, look, you're going to get these more valuable H shares. So you're not going to get the S shares anymore. They say to the S staff, you're going to get H shares instead. But we're just going to extend the period. You've got to work for us for another, or for 3 full years from that date. So draw a line there, and that is the H vesting date. Okay, that is the date upon which the H shares vest with the employees. And all you need to know is IFRS 3 says that to the extent that H is replacing an existing share-based payment scheme, that does form part of the fair value of the consideration given for the business. In other words, we need to work out debit investment, credit, share-based payment reserve, statement of changes in equity. But we need to calculate how much to put in at the acquisition date. All right, so just going back to my full answer that I had there, show you share-based payment reserve. So here I just did it as part of this entry. Now I'm isolating it for you. Okay, so I'm trying to work out what amount goes in there, because if you put an amount in there, it's going to make the investment bigger, isn't it? Your balancing figure is going to be that much bigger. Good, that's what you're trying to work out. And there are some really peculiar little rules that we are forced to follow in terms of IFRS 3. Okay, so we read facts and circumstances further, and let's have a little closer look. They tell us that the fair value of one S option at the grant date, the 1st of Jan 2010, is $20, but that includes the effects of that 3-year service condition. Now, you guys wouldn't know that yet, but when you calculate the fair value of a share-based payment at the grant date, you always take into account market conditions. You never take into account service conditions. So that figure is not relevant. The fair value excluding service conditions is 18. So let's keep a track here of the S awards. They are worth 18 at that date. And then they tell us at the acquisition date, an S award is worth 23. So at that date, it's worth 23. An A award at that date is 28. Okay, so I think I've got all the information that I could possibly need up there on the board. Okay, so first thing you're going to do is I need a value. All right, it's either the 18 The 23 or the 28? Common sense has got to tell you it's the 28. Because what is A paying? They're paying with their shares, not so. Staff aren't going to get S shares anymore. They're going to get A shares. And the fair value of an A option at the replacement date is 28, isn't it? Okay, so I mean, common sense has got to say, use the 28. Don't use the 28. IFRS3 says, use the 23. It says, use the fair value. So just specifically, for the purpose of working out how much of that share-based payment replacement is part of the cost of the investment, they say, use the fair value of the awards being replaced in the acquiree. So use the fair value of an S award, not at the grant date. Now, S would have used the fair value at grant date in order to calculate their share-based payment reserve. You are going to use, for the purpose of this entry specifically, the fair value of an acquiree award at the acquisition date. Times by 100 employees. Or sorry, times by 1,000 options per employee. Times by 100 employees. But you do build expectation into this thing. So at the acquisition date, did we expect there to be 100 employees by the end of the vesting period? And they're going to tell you that's not the case. They're going to tell you here that we estimated that only 95% of the employees, or 95 of the employees, would remain in service. So we do take that into account. Sometimes you'll multiply by a percentage. Sometimes they'll say to you, we expected 12 people to leave. Then showed as 100 minus 12. So that is the best estimate we've got of the fair value of the equity that A is going to have to issue to the S staff. Last thing though, what A is purchasing is this motivated workforce. And they have only been motivated for this long. I think you'll agree with me that to the extent they carry on working for the group, that should be an expense of years to come. Hey? All right. And IFRS 3 makes that clear. So I only want that period. I only want this little period over here. Little period, let's call it A. How long is A? 6 months, is it? 6 over what? And here's the other funny little rule. Okay. A over the longest period on that timeline. So, starting from here, ending at here. So you start at the grant date, S's grant date, and you end at the later of the S vesting date or the H vesting date, whichever is longer. So how long is that period? I think it's 42 months. Do the arithmetic. $36 months plus the extra 6 months that H tagged on. If H made their period shorter, you'd use the 36 months. Okay, so it's always the later of those two. So what you're looking at is you're looking at this value over here, proportioned for the period already worked. The period already worked is this period over here. And when I say, so what proportion do you use? You're going to find you might have an H vesting period and a different S vesting period. Use the longer of the two. I don't know how much common sense is in all of that, but I do know That is the way you're expected to do it in terms of the illustrative examples that demonstrate this point in IFRS 3. Okay, so take it from me. If they ask you this, that's what they'll ask you. Give me a number, please. 312-143. 312-143. So if I was to show that aspect of the acquisition in H's separates, it would look like that. Alternatively, if I asked you for the journal entry to record the acquisition in the separates, that 312 is the figure that you would fill in there, which would make your investment 312,000 bigger, obviously. Okay. You could quite easily get a question of that caliber, whether you level 1 or level 2. I'm just suggesting level 2s, you might get the share-based payment reserve. Level 1s, I'm suggesting you won't. All right. That would be, I would think, in total, somewhere between 20 and 25 marks. In H's books, since acquisition until the end of the year, they've got a couple of things they need to consider. One of them is interest on that liability at 12%. The other one is the remeasurement of the contingent consideration liability. I think it's 30,000 in this example. It went from 320 to 350, if I'm not mistaken. Since acquisition until the end of the year, as far as the pro formas go, the pro forma entry is concerned, if that was our, if that was our pro forma entry, we need to depreciate or amortize that reacquired right over its remaining 2.5-year life. You debit an amortization expense, credit accumulated amortization, call it depreciation if you like. Before the end of the year, that contingent liability has been settled, or alternatively, it's been raised as a separate liability in S. If S has done the liability, you don't need that anymore. Get rid of it. Debit contingent liability, credit profit or loss. You'd need to give NCI a share of their profits. You'd need to test that goodwill for impairment. Okay, those are the stock standard things you do in any consolidation. And that's the bit I'm saying to you, you can never get wrong. The level of complexity here, that might be a 5-mark entry, it might be a 2-mark entry, it might be a 20-mark entry. And last little point before I leave this, just watch out. Often, they only ask you for the pro forma. In the pro forma, we have that. How do you work out that? The only way to do it is to go and do the entry in H's own records. Yeah. And if I told you here you weren't buying a subsidiary, but you are buying the assets and liabilities of a business, you wouldn't have any pro forma entry. The entry in the records of the holding company would look like that, excepting you wouldn't have a one-line investment here, would you? What is the holding company buying? The individual assets, those that you can identify, that meet the definition, for which you can work out a fair value. And the liabilities you can identify, that meet the definition, for which you can work out a fair value, line by line, with a figure for deferred tax if necessary. And the deferred tax let's say there's a reacquired right. You'd bring it in as an asset, eh? So you'd have the reacquired right, and its carrying amount that you'd bring into your journal entry is 100,000. What tax allowance do you think SARS gives on that reacquired right? And very obviously, friggin' nothing. I mean, we made up that number, so IFRS technical, SARS wouldn't have a blooming clue what you were talking about. Okay, there certainly isn't a tax deduction, a capital allowance in the Tax Act that deals with reacquired rights. It would be nil. Temporary difference is 100,000. Question is the deferred tax on that, do you provide for it or is it exempt? And you might argue that the temporary difference arises on initial recognition of that asset. And that transaction, your acquisition transaction, affects neither accounting nor taxable income. So you may very well argue that it's exempt. Please remember that that exemption paragraph 12 does not apply to assets and liabilities acquired in a business combination. So you will have a deferred tax liability on that. Put that into your entry as well as a liability. So once you've brought in all the assets and liabilities for each one of them, go carrying amount tax-based temporary difference, do a DT balance calc, and if you get a liability, put it in, get an asset, put it in. Excellent.